Happy 4th of July on the 5th of July. Hope you had a great day. I was up at Honolulu with many people. Had to watch an incredible fireworks show. And let me tell you what, the fireworks are beginning to fly in the housing market. We're going to talk about that. There's a lot of stuff that happened in this holiday shortened week. Man, I tell you what, I'm just getting started. Let's go. 3 green arrows. Oh man, what a great start to July. Housing prices are up, though not a lot. And don't listen to the media. We'll get into that. And then we also had inventory. Inventory's on the rise. We're definitely going to get into that today. And interest rates are coming down. Although they kind of went up at the beginning of the week, but they're back down again. So that's a good thing too. All right, so let's get into the headline news. Inflation is down in the latest PCE report that came out a week ago. But the impact I'll get into here shortly. And then the labor market is cooling. This week was jobs week. And there were reports on Tuesday, Wednesday, and then on Friday. We'll get into that. And then the media is at it again. A lot of clickbait. You may think that I'm giving you some clickbait, but I'm not. I'm just going to show you some numbers. All right. So let's get into the personal consumption expenditure report. This came out on Friday, and it was great news because we saw the core rate of inflation dropped from 2.8% down to 2.6%. That is great news. Headline, not a lot of movement on the headline report, but you would think with a good inflation, remember that this is the Fed's favorite measure of inflation, and they want inflation down at 2%. And we're now at 2.6%. That's over a point lower than where we were last year, yet interest rates went up. And why is that? Well, this report came out on Friday. What happened on Thursday? We had that debate, that debacle of a debate or debacle, whatever it was bad. And interest rates went up on Friday. We'll get into this. I'll show you on the graph here in a little bit. But man, I tell you what, inflation coming down is great news, but the market ignored this largely because of what happened in the debate, all right? And really, there were a lot of reasons why, but Monday, oh man, I'm getting ahead of myself. You got to pay attention towards the end because I'm going to talk about what really happened. And you can see really the effects. It's not just me spewing blabber. It's looking at the data, all right? So we'll get into that. But PCE report came in. That was great news. That was a week ago. And then Wednesday, we had the ADP report. The ADP jobs report came out, and it showed a little bit of slowing in the labor market. 150,000 new jobs versus 160,000 that was expected. Big thing for me is wage growth continuing to come down. Yes, wage growth is still up, but it is slowing down month over month, year over year. So that's great. Down 4.9% for people who are staying in the same job from 5% the month before, down to 7.7% from 7.8% for people who are changing jobs. So I remember people were leaving, over a year ago. They were going to other jobs and getting 10 to 12% increases in their pay. We're not seeing that happen right now, which is the sign of a slowing labor market. Now, and here's the other thing. JOLTS, not a lot of news. JOLTS has dropped a lot. We were over 10 million new job openings just several months ago. Now we're down around 8 million. We've been down in the 7s, so that's good. We'll probably continue to see that happen. All right, then on Friday, we had the BLS jobs report come out, and there's been a big hit and miss on this one, just depending on which part. There are 2 surveys. There's a business survey, and then there's a household survey. Well, the business survey, the estimate missed again. All right, the expectation was about between 190 to 200,000 new jobs. In the month of June, we had actually 206,000. But here's the big news. Both the May and the April reports were revised 100,000 lower than they were than when they came out in their months. So basically what this is saying is that business report, which gets reviewed and updated twice before it gets finalized, those numbers are not necessarily very accurate. Here's the thing though. The household survey showed 116,000 new jobs versus the 206,000. And household survey is where the unemployment rate comes from. And that went from 4% up to 4.1%. And that's the highest level of unemployment that we have had since November of 2021. This is big. You also see hourly and weekly earnings down. So a big job report that shows the labor market is slowing, inflation coming down, unemployment going up. Are we in a recession now? I don't know if we're in one yet, but there could be one coming. And I know me and everyone else was saying this is going to happen for a couple of years now. We've certainly already gone into a housing recession. We went into one in October of 2022 when interest rates shot up, and you can see that. You look at any chart that shows national inventory, and we'll get into that here in a bit. But this is definitely showing that the Fed's increasing the Fed funds rate, keeping it extremely high for this a long period of time, over a year now, is having an effect on the economy. Inflation's coming down, which is what they want. And their second mandate, part of their mandate, is to control unemployment. Well, they wanted unemployment up. They've said at some points at 4.5% they wanted to see it at. Now they're coming down because that's a lot of pain for the economy. They're thinking 4.1, 4.2%. This could be good for what we see in September when the Fed meets, and maybe they will lower the Fed funds rate, which could be very good for housing. All right, and now let's also look at the initial jobless claims report, which came out on Wednesday, a day earlier than normal because of the 4th of July holiday. And initial claims were up 4,000, which isn't that much, but to 238,000. But that's the fourth week in a row where initial claims are above 230,000. That is the highest level since August of 2023. So you're starting to see a little bit. Look at this. I've been talking about how we've been flatlining on these numbers. You can see a little bit of a bump up. All right, you can see a little bit. That's good. That's good news. I mean, it's not good news for the people who are losing jobs, but that's good news for the economy. It just shows that the labor market is slowing down. That's good because that gives the Fed the impetus to go ahead and lower the Fed funds rate. Well, they're not going to lower it that much, but this just shows the market slowing down. You look at continuing claims, all right, up 26,000. It was up 18,000 last week, up 26,000 this week to 1.858 million people who are receiving continuing unemployment insurance. That's the highest level since November of 2021, people. So you're starting to see, again, it kind of still looks like a flat line, though, when you take a look at it. But a little bit of a tick up. That's good. And again, that's just another sign this week that shows that the labor market is slowing. You got unemployment up, you got wage growth slowing, you got initial claims and continuing claims continuing to increase. So I still think we need to get over 2 million unemployed on receiving continuing unemployment insurance before we really see some movement from the Fed. I think they're probably looking at that, but hey, I'm not a member of the Fed. I'm just some dude in Hawaii who likes to surf and golf. So, okay, so let's take a look at VA rates, people. You know, I do a lot of VA loans. I help a lot of veterans. I educate veterans all over the place. I have a seminar Saturday morning at 10 a.m. over here in Kapolei. But let's look at this, all right? Now, I was telling you how PC, the inflation report, came out last Friday, and you should have seen interest rates come down. Oh, they didn't. Let's look at this, all right? This is a great start to the month of July because we're weathering the storm. You're starting to see June was great. You saw interest rates come down from near 7% in May down to really 6.5% on average for VA towards the end of June. And then we had the PC report. Inflation we're at 6.5%. We get a great inflation report. And what should happen? You should see interest rates come down again. Well, guess what? No, hangover from the debate. And so rates went up, and then guess what? They went up again on Monday. Why? Because over the weekend, all the media people started spewing all this nonsense and the worry that, well, if Trump wins and the Republicans keep the House and they get the Senate, then the Republican Party is going to be unencumbered. They're going to have no opposition, and inflation is going to go through the roof. And that's a lot of what the thoughts were. There's some other things going on. The Japanese talking about maybe selling their U.S. treasuries to bolster their economy, but really, that was short-lived. And to just spend a second on rates coming down if President Trump wins, that may not happen. All right, when Trump was elected in 2016, the day after the election, All right, before the day before election, VA rates are at like 3.25. I'm refinancing all my buddies. The day after, literally the day after the election, interest rates went to 3.75%, and they kept going up for about another year as the Fed started playing around with it. They started raising the Fed funds rate. Rates went up, and if you remember, 2018 was not a great year for the housing market. So all those people who think that interest rates are going to come down if President Trump is elected, think again. There's a lot of other things at play that could happen. But in any case, VA rates, because of at the latter part of the week, the jobs reports, the ADP, the BLS jobs report, interest rates are back down in the mid sixes. Next week's a big week, folks. Next week's a big week because why? Because we have inflation reports. We have CPI, Consumer Price Index, and Producer Price Index coming out. And those, if they show continued decrease in inflation, could send VA rates down into the low 6 range. That could spur a lot of movement in our housing market. All right, so what does this mean for buyers and sellers? Well, applications were down last week, and I think we're getting towards the end of people who are moving. They're making that decision to rent or buy. So you start to see that down. And really, inventory, while inventory's up, inventory on the leeward side historically begins to slow down. New inventory begins to slow down after the 4th of July weekend. We'll go into some charts that show a little bit of that. Depending on where you're at, you are at an advantage right now where there's higher inventory because you can negotiate with your seller to get seller credits to make that house, which the value is still there. You're not seeing housing prices drop in Oahu, and in many parts of the country, you're not seeing home prices drop because there is a lack of inventory. You have an opportunity to make that house affordable. You can do a 2-1 buy down. You can pay your closing costs. So this is really, I think, for seller or for buyers in many areas, this is a great time to buy. And for sellers, I mean, you can wait, but it depends on what you got going on in life. You're still, if you bought your home, more than 2 years ago, you're still going to make a pretty good chunk of change. If you bought the home in your last 2 years, you're probably not in a position to sell just yet and make money. It just really depends on the area you bought. But for sellers, you're probably still going to be giving seller credits. But if rates come down, if VA rates get down from, like I said, they're mid 6s right now. If they get down into the 5s, you're not going to have to give credits because you're going to have a lot more people putting offers on your home. So, but I will tell you this: I just had another client get a home, did I say that? I think I talked about that last week. $40,000 credit on a home they are purchasing. All right, below market value, $40,000 credit, and guess what? All right, the home appraised at the purchase price. I'm telling you what, you work with the right realtors and you have the right education and you know what you're doing, you can score a deal. This family here, and they're making out, and they got 3 years to live in the house. They're moving in free. They're not paying a cent. Matter of fact, they're paying off a credit card. Right? They are getting a 2-1 buy down. They are not paying their closing costs, and they're paying off a credit card for like $10,000. So that's pretty damn good, I think. Anyway, let's get on. All right, my good friend Mike Green, he's a classmate of mine from the Naval Academy. He posted something on Facebook this morning. It's a article from Newsweek talking about housing market. This is a headline: housing market entering crash stage in multiple cities. There's a lot of big words in there that are trying to scare. It's a clickbait article, and I'm going to show you why here in just a second. So let's look at, this is a report from Altos. Altos, they do a market research, real estate across the country, and it just shows that this article is talking about, the inventory has increased by 40% over the last year, blah, blah, blah. You know what? That's true. But for the nation as a whole, inventory is up from all-time lows in 2022. All right, right before the market turned, right before interest rates started to go up, our inventory had depleted across the country. You look on this graph here, this Altos graph, all right, below 280,000 homes inventory across the country. All right, if you look at before COVID, we had over almost 1 million home inventory. So you're seeing a drop from 100,000 to 250,000, 75% drop in inventory. Well, gosh, if rates kept going down, that inventory would keep going down. Nobody'd be able to buy a home. Interest rates started to go up, and you can see this is across the nation. I'm going to break this down into a couple of different areas here. All right, as interest rates started to go up, inventory went up, but it didn't go up that much, people. All right, 2022, end of 2022, inventory got up to over 500,000 homes, and still half of what we were before COVID. And then interest rates dropped in 2023. I don't know if you remember that. January to March, first quarter, interest rates dropped. And look what happened to inventory. It dropped a lot. All right, back down near 350,000. All right, the interest rates started to go up, and guess what happened? Boom. All right, inventory started going up again. And you know what? Interest rates are high. Man, two years of interest rates being high, inventory's going up. But you know what? We are still, all right, we're still like maybe almost 700,000 inventory. We're still below where we were before COVID, all right? And it's not like we have a dwindling population. There are more 4 million new household formations joining the market every year. We don't have enough homes, and we're certainly not building enough. So let's look locally. I'm going to look at three areas. I'm going to look at Honolulu County. I'm going to look at Austin, Texas, which is where one of the areas where you're seeing an increase in inventory and home prices are coming down. And it's indicative, and there's a lot of reasons why. We'll get into that maybe a little bit. And then Virginia Beach, which is where the broker is on the East Coast. It's where our headquarters is. So let's look at Honolulu County here. Inventory is up, but to $23.59 a month. This is housing inventory monthly, $23.59 active inventory. Before COVID, we were at over 3,000. So in 2022, inventory dropped to, about 1,300. All right. So now we're from 1,300 down to 2,300. So up, 1,000, but still about a third lower than where we were before COVID. All right. And let's look at this. All right. Look at this big drop from January 2023 down to about March of 2023. When interest rates got into the fives again. I remember that. I was doing a lot of purchases back last year in January through March. Look at how the inventory fell off a cliff. All right, we don't need interest rates to drop that much, but we do need them to come down. They always say real estate is about location, location, location. Hey, that's no different. All right, that's no different. I'll show you why in just a second. But I will tell you this: as rates go down, inventory will start going down too. And while inventory, if you kind of look, after the 4th of July, typically inventory goes down. July inventory goes down, but this is also in 2020, 2021. That was also because it was just such good, such low interest rates. That's Honolulu County. Let's now look at Austin, Texas. All right, Austin, Texas, proof that it's all about location, location, location. Before COVID, inventory in Austin was between 7,000, 8,000, 7,500, 8,500 homes, active home inventory on the market. Then after COVID, you see this huge drop. All right, what did you have? Well, you had a lot of people moving to Texas. Austin took off. I know that Tesla opened their plant there. I had one of my clients move from Hawaii to Texas, bought himself a great home. He's working at the Tesla factory in Austin. Home prices went up, and now you look at this. As rates went up, you look in 2022, inventory shot up. They also had a lot more building going on. Inventory typically drops after the 4th of July, and you're probably going to see that again. The inventory now is above the inventory level that we had before COVID. So you have an influx of homes on the market there, but our home prices falling off a cliff there? No, they're not. Sellers are having a harder time, and buyers are actually at an advantage there. I don't think there's a housing crash as much as the inventory is picked up, and the affordability is low. And the article is right. Affordability is at all-time lows, 100%. If you're buying in Austin, you actually, as a buyer, you should be able to get a pretty darn good deal. And this just goes to show the risky nature of buying homes short term. If you bought a home 2 years ago, you're probably not going to make any money on it in Austin, Texas right now. All right, so that's Austin. Let's take a look at Virginia Beach, all right, where my daughter lives, where my company is. This is, talk about location, location, location. I've had several clients move to Virginia Beach, the Hampton Roads area, and they have had such a difficult time buying a home after COVID. It doesn't matter whether they're first-time home buyers looking in the $300,000 range or they're looking in the $700,000 to $800,000 range in Virginia Beach. The inventory is so low there. Look at this. Before COVID, I'd say the average is about 2,000 homes on the market, 2,000 to 2,500 homes on the market before COVID. And then 2019, we saw a resurgent interest rates started to come down. Look at the inventory dropping, all right? And then you had COVID as we go across that gray line, and then interest rates fell off a cliff, and look what happened to inventory. So you went from 2,500 before COVID on the average. Now you're below 500 active inventory of homes in Virginia Beach County. Folks, that is unhealthy. And anybody who lives in Virginia Beach and is trying to buy a home there, hey, you know, if you're a seller, you're going to make some money because there's just such a shortage of homes in that area. You have a huge military component. You have a lot of tech there as well. It's much more affordable. I mean, I took a duty station in Norfolk where I never ever wanted to go because I knew I could afford to buy a home there back in 2005. And I did. And that's what a lot of people are doing. They are going there. They want to settle down. They have great schools there. Hey, it's a great place to live. And you know why? It's all about location, location, location. Home prices in Virginia Beach are very high. Inventory is historically low. Despite interest, dude, 2020, let's look at this. Right when rates started to go up in 2022, say 613 inventory 2022. That's June of 2022. All right, it'll say July, it was 721. All right, that's when interest rates started to go up. And then in May of 2024, inventory is at 562. So despite interest rates being between 6 and 8% over that time frame, inventory has dropped. Inventory has dropped in Virginia Beach. That's tougher than Honolulu County, people. Anyway, getting off my soapbox now. It's all about location. This article is clickbait. Home prices are slowing down. You can look at interest rates. You can look at weather. You can look at insurance. You can look at an influx of building in certain areas, but really nationwide. New homes are way below normal. I think that article, well, it got me interested anyway. Got a lot of my friends interested. Anyway, hey, you guys have a great weekend. Next week's a big week. Inflation reports coming out. Stay positive, stay cool. Have a great weekend. Aloha.